Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me from the Bangalore studio is Ritu Singh. These are the top headlines from the startup world. Dozens of Indian startups that banked with SVB remain on tenterhooks even as US government promises to allow access to their accounts. Nazara Tech subsidiaries hold nearly $8 million in SVB. Indian banks offer new dollar accounts for startups to tide over the crisis.
Legal tech firm Fight Technologies launches a fund with claims under management of 100 crore rupees. The fund will invest in 15 to 20 commercial cases with an average ticket size of 5 to 7 crore rupees for a tenure of 2 to 3 years. The fund will allow investors, especially HNIs, to invest in these litigation cases where the annualized ROI is expected to be upwards of 30%.
D2C brand, the Ayurveda company, bags 100 crore rupees in a Series A funding round led by 6 Sense Ventures. Funding round also saw participation from actress Kajal Agarwal and others. The company will use the funds to expand its offline presence, improve product manufacturing, expand research and development.
Trucking marketplace Raho gets 20 crore rupees in an extension to its pre-Series A round at a valuation of 4 times the last year. The round was led by Inflection Point Ventures, Root Ventures, Bloom Founders Fund and others. It will use these funds to strengthen its data science and ML capabilities.
Microsoft conducts a third round of layoffs that impacted employees in roles related to supply chain, artificial intelligence and Internet of Things. Job cuts were across various levels, functions, teams and geographies. US President Joe Biden has started talking about the SVB event. Let's cut across the network to take a look.
Taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Second, the management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. And fourth, there are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable. In my administration, no one is above the law. And finally, we must reduce the risks of this happening again. During the Obama-Biden administration, we put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd-Frank law to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses. Look, the bottom line is this. Americans can rest assured that our banking system is safe. Your deposits are safe. Let me also assure you, we will not stop at this. We'll do whatever is needed. On top of all that, let's also take a look at a moment to put the situation in a broader context. We've made strong economic progress in the past 2 years. We've created more than 12 million new jobs, more jobs in 2 years than any president has ever created in a single 4-year term. Unemployment is below 4% for 14 straight months. Take-home pay for workers is going up, especially for lower and middle-income workers. And we've seen record numbers of people apply to start new businesses, more than 10 million of them, more than 10 million applications over the last 2 years starting businesses. Now we need to keep this progress going. That's what swift action that my administration over the past few years is all about. Protecting depositors, protecting the banking system, protecting the economic gains we've made together for the American people. Thank you, God bless you, and may God protect our troops. See you in California.
Mr. President, what do you know right now about why this happened? And can you assure Americans that there won't be a ripple effect?
Do you expect other banks to fail, Mr. President?
Should all depositors be protected at all banks?
All right.
Questions, speaking for a shorter amount of time than maybe perhaps some expected, but reiterating that depositors will be protected, management to be fired. investors not protected. And then again, as Gensler this morning, Jim suggested, those who are found of any wrongdoing will be held accountable.
Yeah, I mean, I think it's difficult to find someone who exercised their absolute right to be able to invest anywhere on the curve from being considered
a bad actor.
Just
Yeah,
a bit,
right.
I want to get that off the table.
Silicon Valley Bank made a choice a couple of years ago with that huge influx of deposits to put it into longer dated securities that had a higher yield. I think, of course, they wish they had not reached for that extra 50 basis points, and we wouldn't be having this conversation.
But David, do you think a competent bank examiner should have said, you know what, you have a lot of risk here because you really are far too out the curve, given the fact that the Federal Reserve says it's going to keep raising rates?
Yes, I think that would potentially have been a fair point. And listen, it wasn't a big secret to many in the marketplace that they did have a bond portfolio that was at least on a mark-to-market basis underwater. Of course, it was in the held-to-maturity portfolio where that did not have to.
So that was the American President Joe Biden saying that the American banking system was safe and that the taxpayer will not bear any losses. However, he did say that they will hold those responsible for that accountable. But moving on, with an aim to consolidate market leadership in downstream supply chain financing, Mintify raised $110 million in its Series D funding round. With the fundraise, the company aims to not only deepen presence across key sectors, but to expand on its new offerings and bolster its tech infrastructure. Now, the round was led by Premji Invest, with participation from existing investors like Norwest Venture Partners, Elevation Capital, and International Finance Corporation. Joining us now to discuss the company's growth strategy is Anup Agarwal, the co-founder and CEO of Mintify. Anup, thank you so much for joining us on the show today. You know, let's straight get into it. What are your current products that you have on offer? Any new ones in the pipeline? What will the focus be going forward?
Sure. First of all, thank you so much for having us here. Our main focus has always been on the downstream supply chain financing side,
Right.
where think about a structure where we partner with some of the leading corporate partners in India to work along with them across their supply chain to offer inventory financing solution to their distribution partners. These are typically what we call as a long tail of the supply chain, where they are micro enterprises looking for working capital to buy inventory and grow their businesses. Initially, we were only focused on what we call as a primary sales, that is between the corporate to their distribution partners, the typical wholesalers, stockists, distributors, and so on and so forth. As we're expanding our business, we are also getting further downstream to the retailer side of the network as well, where we are financing the entire retail chain as well. And that's where we are seeing massive opportunity and growth for us, going forward.
All right. Now, Mintify plans to use a large part of the proceeds to expand its loan book and focus on growth of disbursals on the platform. So talk to us about where your loan book currently stands and how much do you plan to grow it by? What about NPAs?
Yeah, so we've been growing pretty rapidly. Last just about 12 months alone, we have seen about 300% growth in our overall loan book. As we speak, currently we are at about $150 million of loan book, which will easily expand to at least about $400 to $450 million by March 24. So another about 200+% kind of a growth. A large part of the proceeds will go towards financing this growth on the lending side, but equally important is we are also building a lot of SaaS-led solutions for the entire supply chain. So when you talk about supply chain, it's kind of an ecosystem that you're operating. It's just not financing. Financing is just one aspect of the overall business that you do. But across this network, be it a corporate to the distribution partners and the retailers, there is a lot of friction that exists in terms of the way you collect the payments, the entire order to cash cycle and stuff like that. Mintify as an organization is building one single stack to ensure that the entire ecosystem can be brought on a single platform for doing multiple services, and financing being certainly a core of one of the solutions that we're going to offer to our corporate partners.
All right. And what are the ticket sizes of the loans that you currently have, and how much have you disbursed so far? What's the target going forward?
So we are fairly granular in terms of our loan book. Our average ticket size is about 15 lakh rupees. We've overall, for the last 5 years since we went live, we've already disbursed about $1.7 billion worth of financing across about 20,000 plus SME partners.
All right. And like you said, purchase financing is a $50 billion opportunity, and that's what you're going to focus on. So what's the traction you're seeing? And will this be the primary solution that you'll focus on? What are the targets that you've set for yourself on this front?
So, as I was saying earlier, the opportunity is fairly massive. We are talking about at least, if not more, a $50 billion opportunity, which itself is growing at about 10 to 15% year on year. So imagine a situation where any receivables which is sitting on the balance sheet of any corporate partner, be it in FMCG, pharma, kitchenware, consumer durables, the entire ecosystem where the corporate has to extend credit to their distribution partners for them to buy inventory, and the distribution partners in turn having to offer credit to their retail partner. That entire ecosystem has receivables outstanding. And the reason why there is a receivable because they are dealing in turn with smaller and medium enterprises which do not have access to working capital. As an organization, we are very focused on ensuring that that entire receivables can be liquidated in the balance sheet of these corporate partners, and Mintify in turn can step into the shoes of financing these SME partners. Now that opportunity itself is very large. My belief is that over the next probably 3 to 5 years, we can easily build at least a $2 billion financing book. But in addition to the financing book, we'll also build a lot of services layer, which is going to be a fairly significant part of our overall business.
All right. In fact, Mintify has grown about 4 times year on year. Where will you end this year in terms of revenue? And what's the road to profitability looking like?
So maybe I'll just take the second one first. We've always been super profitable. I think one thing as an organization that we've always strived towards is on the unit economics side, unlike a lot of companies. And the flavor of the season, everybody's talking about profitability, but let me emphasize it here. Even in FY 21-22, when we were in the COVID year, we were a PAT positive company. As we speak right now in the FY 22-23, we are already hitting an ROE of about 12%. And next year, we will easily hit an ROE of about 16 to 17%. So we are a very, very profitable company and very focused on the overall unit economics.
All right, focused on unit economics, and you are profitable. Now, you work closely with over 100 leading brands across India, which includes Tata Motors, Jockey, Finolex, Varun Beverages, etc. So how do you plan to grow your client base, and what's the expansion plan?
So this is, think about it like a SaaS solution where you have to do a lot of enterprise sales. It's not easy to kind of onboard some of these large corporate partners. But I think a combination of, the tech solution that you offer, the understanding that you have about these industries, and of course, a fairly massive distribution network, because eventually you are dealing with, corporate partners who have billions and billions of dollars of sales, having a massive distribution network on a pan-India basis. You cannot just be, offering this solution to them in a particular region or in a particular, division of theirs. So as an organization, we built a lot of expertise in order to ensure that we are able to cater to these corporate partners. We believe that there are at least about 5,000 plus large enterprises in this country who need a similar solution that we are currently offering. We are only at about 150. We can easily tap in at least about 1,000 plus corporate partners over the next 3 to 5 years.
All right, 1,000 plus corporate partners in 3 to 5 years. All right, Anup, we're completely out of time. Many thanks for joining us on the show today, and we wish you all the best going forward.
Thank you. Thank you. Bye-bye.
All right. On that note, it is time for us to head into a short break. But trucking marketplace Raho has raised 20 crore rupees of funding in an extension in its pre-Series A round. The company's co-founder talks about its growth strategy on the other side. Stay tuned.
Guys, this is not connected.
Welcome back. You're still with us on Startup Street. Now, trucking marketplace Raho has raised 20 crore rupees of funding in an extension to its pre-Series A round at a valuation of 4 times over last year. Now, the round saw participation from Inflection Point Ventures, Roots Ventures, Bloom Founders Fund, and angel investors like Vijay Shekhar Sharma, Kunal Shah, among others. Joining us now to talk about how the business is doing and how this funding will help is Mohammad Imtiaz, the co-founder and CEO of Raho, and my colleague Ritu is with us as well. Imtiaz, thank you so much for joining us on the show today. Raho wants to use these funds to expand its presence in India and strengthen its tech capabilities. Tell us what your plans are on this front now that you've raised more funds.
Thank you, Arundhati and Ritu, for having me on the show. So we are super excited. There's a very, very large market. Trucking is a extremely fragmented market, which is the total size of the market is $200 billion. We are very glad to see our existing investors and new investors join the bandwagon. We are a 6-year-old company. The focus of the usage of this fund is that today, from a geography presence, we are present in 15 cities. We would like to move these 15 cities to 25 cities. And the most importantly, the fund usage will be in the area of technology. We believe that the whole trucking marketplace or matching in which a truck is given to a customer is very unorganized, is very paper-driven. I would call it is a very, it lacks complete automation. We believe that from a completely paper-driven matching to an automated matching, we'll need a lot of data science and machine learning capabilities. Most of our fund utilization will be in this area of building technology to be able to move towards automated matching.
All right, the bulk of the funding, Imtiaz, will be towards this automation. But, let's talk about the trucking industry in India. That is largely unorganized even to date. Now, you are a digital broker of sorts for these truckers. In terms of an opportunity, what is the size? But also with growing competition, how much of the market share do you think you could capture?
So let's look at this, right? From a logistics is like 14% of India's GDP, and good 6% of that is trucking market, right? That's $200 billion market. We play in the intercity trucking space, which is 80% of that is $160 billion market. So $160 billion unorganized market, less than 2% of this market has gone digital. The way this market works is that at one end you have a trucker, the trucker size of 80 lakh trucks that own in India, most of them, or 85% of them, own less than 10 trucks. So you'll have a long tail of truck owners, which is extremely fragmented. And then there are thousands of shippers. In between lies roughly 100,000 unorganized brokers. Today, Raho actually replaces these traditional brokers by being a digital freight broker. So from a market opportunity size, I think it's $200 billion market, right? So that's a huge market. And from a competition perspective, this market is very, very early, right? A lot of people are trying to look at this market from multiple ways. Somebody is looking at this from a load board approach. Somebody is looking at part of the transaction. We come as part of the transaction, something very similar to Uber for trucking. So from a competition, I think the more the competition, the better, because the way to look at it is that 98% of the market is non-digital, and that's a market that we all have to work hard in making it digital, right? So that's a huge opportunity. So I believe, more the players, the better it is, because we need to make this market move towards automation.
All right, Imtiaz, $1 billion opportunity, but you're not telling us what your market share could be. But be that as that may, you claim that your business had grown by about 5 to 6 times since pre-COVID levels, and you also have profitable unit economics. But what we're seeing now is the government's initiative to shift all the cargo movement away from roads and towards railway and inland shipping. What would that mean in terms of your growth and sustainability of this growth in the near term?
Yeah, so yes, we have grown around 7x. A lot of tailwinds for our business, right? Every other business has gone digital. So clearly, we are one of those, trucking is one of those last bastions that need to go digital, right? We need to make life better for a trucker. So from a tailwinds perspective, of course, the growth is coming. We've always been unit economics positive, right? And when I say this, I would say that the 20 crores is going to last us. This gives us a runway for almost 2 years. Yes, 65% of India's transportation happens through road, 32% happens through railways, and a very small percentage happens through water and air. So shipping, it's too small, so it doesn't really impact. Of course, government really wants to remove the loopholes or concerns that exist on the railway side, because the last mile and the first mile needs to be thought through. I think that's one area which is definitely going to grow. But I personally believe that there is an equal amount of focus when it comes to road. If you look at it, the roads are getting better. The FASTag is helping, move things faster. What would have been considered a normal, let's say 5 days from Delhi, Chennai, today, that has gone to 3 days. So clearly the roads are also getting better. More and more highways are coming into play. The new national logistics policy that you see is focusing on building warehouses and infrastructures in smaller towns, which would definitely mean, big time growth in the roadside. So I believe that road transportation percentage will more or less remain the same, even if the government starts, putting a lot of pressure or growth focus on shipping or, let's say, railways.
All right, so road transportation is here to stay. Never mind the government's push otherwise. But, lastly, Imtiaz, if I were to ask you to take a more macroeconomic view, the long-term ambition as far as Raho is concerned, do you want to remain a trucking marketplace alone, or do you think you could have a larger play in India's logistics story?
65% of the market is, transportation is happening through trucks. So I personally believe that that's a very large market. Today, we play in the intercity market and largely in the container truck. we believe that we will continue the intercity space, which is $160 billion market. We might open up into maybe open trucks as we go on, but I personally believe it's large enough market to digitize and take us another 5-7 years to digitize and bring all the truckers and all the customers into our platform and move towards automated matching. So I think it's a large enough market. I told you 22% of that has gone digital. We have to come together to make this $160 billion market go digital. So I think currently we'll continue to focus on it, but I think a lot of focus will be about how do you make this automated, right? That's the only way to scale this up to 100x from where we are today.
All right, so Rahul, the takeaways will remain a trucking platform at least for now. That is the plan. Imtiaz, thanks very much for your time here with us on Startup Street. On that note, we're going to wrap up this edition of the show, but stay with us. More news and updates will continue on the other side.